Let's talk about how to value a business for an acquisition. There are three main valuation techniques that are used across corporate finance. Whether you're working in investment banking, equity research, private equity, you name it, you're going to be looking at these three main methods of valuation. The first method is public company comparable analysis, or comps for short. This involves looking at public companies that are similar businesses in similar industries and seeing at what they're valued at in the market. We then compare those valuations to the business that we want to apply a value to. The second approach is precedent transactions. This involves looking at past M&A transactions. We look at what other companies paid for businesses as an outright acquisition. Just as with public company comparables, we also want precedent transactions to be similar types of businesses and in similar industries to what we're trying to value. These two categories make up the relative valuation section of that business valuation. The third category is discounted cash flow analysis, or DCF. DCF analysis looks at the intrinsic value of the business. It is not relative to any other business and looks solely at the business on its own. So as I mentioned, the first two, public company comparables and precedent transactions, are a form of relative valuation. They typically look at equity multiples and enterprise value multiples. In the next section, we'll talk about the difference between those two. On the DCF side, we've got the standalone valuation for the business, looking only internally or intrinsically at the value of the business. However, if it's being used to value a business for acquisition, as in this case, we may also factor in synergies, which are cost savings that we could expect to achieve as a result of integrating this business with ours. So taken in combination with a standalone value, the synergies typically add significant value over and above the standalone and indicate how much we might be able to pay for this business. So for anyone who's looking for a career in corporate finance, whether it's on the advisory side at an investment bank or at a public accounting firm, you're going to have to be very familiar with these three types of valuation. If you want to go on the corporate side of things and work in-house in, say, corporate development or FP&A, again, you're going to have to be familiar with these types of valuation methods, as they'll be useful for you inside the company as well. Now, just to review one final time, and to really make it clear, if you ever get this question in an interview, or if you're ever asked about valuation in the context of corporate finance, there are three methods of valuation. First is comps, comparable company analysis. 2, precedents, past M&A transactions. And 3, DCF, or discounted cash flow analysis. This summarizes the main forms of valuation that you'll encounter in corporate finance.